this all emerged as the result of EU policies and sort of nationally based political upheavals against the sort of political and economic status quo in Europe. So what you're seeing is a need for greater risk analysis at the national level and an understanding of how that pertains to the European level writ large and how that's going to affect your opportunities and your risks. This requires greater geopolitical risk intelligence. You're also going to see potentials for corruption potentially increase. But continent-wide, this creates economic uncertainty.
Companies operating in today's global economy really need to get an understanding of the international geopolitical risk landscape. At Infortal Worldwide, we work with our clients on solving risk before it starts. Welcome to the Riskology podcast. This is a 5-part series on geopolitical risk intelligence, where we're looking at managing business risk globally and really understanding the geopolitical risk landscape.
Hello, everyone. Tom Fox back again with Ian Oxnevad for our continued exploration of geopolitical risks, brought to you by Infortal Worldwide. First of all, welcome back, Ian.
Thank you.
Ian, today I wanted to take up Europe. And this may be a surprising geographic area for business executives and compliance to think about geopolitical risk, but it's equally risky. And even the more developed countries have risk. So I'm going to be very interested to see how you would help a business think through that, and then perhaps some of the concomitant opportunities that may exist now and in the future in Europe. So what are you seeing in terms of the geopolitical risk that you would identify for a company?
Europe's been under sort of constant internal stressors and external crises since prior to COVID. Going back to 2008, you had a banking crisis where it seems like we're sort of back to the future in the sense of you had a major banking crisis that undermined the future of the euro potentially back in 2008. And now they're having another banking crisis. Credit Suisse was just bought by UBS for 3 billion Swiss francs. And there's instability in Deutsche Bank. And these are major banks, unlike in 2008, where you had the acronym Portugal, Ireland, Italy, Greece, and Spain, or the PIGS, where these peripheral European countries known for banking and economic instability. Now you're talking about the core of Europe, where you're talking about Deutsche Bank and Swiss banks. So you're having this greater push for financial integration running up against external pressures, everything from the Russia war in Ukraine and increased energy prices to instability in the Middle East and North Africa and unchecked migration. And then you have an increased populism risk as well internally. And these are all creating political pressures that has the potential to severely change the EU over time, as well as the euro as a monetary unit. Energy inflation spiked, and this is a big issue because you're talking about monetary instability and energy problems as well on the supply side and the demand side. Europe's hands are tied in a lot of ways in how it deals with this if it tries to keep the status quo. Annual inflation rose by 40% in June of 2022 as the result of Russia's invasion. And it's still high as of February of this year. It's still like 16.6%. And these create ongoing pressures in other parts of the economy, everything from consumer spending capacity to production capacity, the ability and affordability of manufacturing. And this goes all the way up the supply chain. And you have the highest cost burdens in Ireland, the UK, Germany, Italy. And government spending increased to sort of offset this cost to consumers. You had 146 billion euros in Germany alone, which accounted for 41% of government intervention to sort of blunt the effects of the invasion of Ukraine and the cost from that. And this creates a massive pressure on the euro because none of these countries have independent monetary policies anymore, meaning that all they can do is navigate things by fiscal means. What do you spend on and how? They can't print or change rates, et cetera, because of the euro, those countries that are on the euro. And this creates a policy incapacity in terms of dealing with some of these pressures, where you need to increase defense spending because of Russia, but you also need to increase different supply chain issues. You need to increase protections for consumers. How do you do all of this? From an economic standpoint, that's a lot of pressure. And there's growing resentment across the EU and across the Eurozone from both the left and the right. You have these sort of emerging populisms growing in Europe, where you have animosity towards incumbents that's starting to become palpable, right? You see it in France rioting right now. Currently, it's like day 11, and that's just over the raising of a retirement age from 62 to 64. That's created an erosion of the support for Emmanuel Macron's government and increased support for the far right, and is normalizing and mainstreaming what was once a fringe party. If the National Front continues to grow and to take power, European integration and the laws and regulations that come with it is in severe jeopardy. Because what this does, if you're looking at Europe as a region from the US standpoint, you want to jump in or do investments in Europe or work in the region or work with European investors, all the rules may change suddenly overnight. Everything from regulation to taxation to just the monetary unit itself potentially. And all of these are pressures that are driving the need for risk analysis down away from just the EU itself down to the national level, which everyone thought was sort of a thing of the past. You see other signs of this in Italy, where the Meloni government took power in 2022. That also indicates a European rightward shift. You see it in the Netherlands, where the Farmer Citizens Movement, or by its Dutch acronym BBB, was a brand new political party. It took like the largest share in the Dutch upper parliament. And this all emerged as a result of EU policies and sort of nationally based political upheavals against the sort of political and economic status quo in Europe. So what you're seeing is a need for greater risk analysis at the national level and an understanding of how that pertains to the European level writ large and how that's going to affect your opportunities and your risks. This requires greater geopolitical risk intelligence. You're also going to see potentials for corruption potentially increase. But continent-wide, this creates economic uncertainty.
Your view, has there been an opportunity for U.S. companies, particularly U.S. energy companies, to not simply temporarily restock energy needs in Europe, but perhaps reorder the delivery of energy raw materials, liquefied natural gas, other types of energy to Europe and the United Kingdom because of the Russian invasion of Ukraine?
Absolutely. And we talked about the dollar before. If the dollar weakens, Europe, if the euro is stronger than the dollar, Europe would be a natural export location for U.S. goods and services. That includes energy. The sort of traditional thinking of the past 30 years, if you're a major American company or even a mid-sized company, and you're looking at manufacturing abroad, importing to the U.S., you may have greater opportunities now to start to manufacture in the U.S. and export elsewhere as a result of all these different instabilities, whether it's purely political as a result of geopolitical tensions with China or just pure purchasing power issues, EU versus the US, and the euro versus the dollar, which are not the same thing, by the way. The Eurozone is separate from the European Union, but most people conflate them. That's something also to keep in mind. But enough Eurozone countries are members of the EU that it's worth combining those risks and those opportunities, those factors when you're actually looking at Europe. So from an energy standpoint, exporting, yeah, there's a lot of opportunities to be had in Europe.
I don't think you touched on a couple of issues I wanted to explore, and that is, I'll broadly categorize it as regulatory, but it's GDPR and ESG. Obviously, Europe is far ahead of the United States in data protection and data privacy laws, having a company or country continent-wide EU law, although enforced by the member states. And the same with ESG, very robust ESG, all the way from Supply Chain Act. I'm going to call the UK Modern Slavery Act part of that, although I recognize the United Kingdom is no longer a part of the EU, but also in reporting of carbon emissions, et cetera. Do you see those areas of regulatory actions as risks for U.S. companies? And how do you help a U.S. company think through managing those risks?
Well, from an ESG standpoint, I think the biggest thing that companies need to understand is that they're countervailing risks facing this. Because of the push for renewable energy, et cetera, by means of regulation that is baking inefficiencies into the technologies that are being produced. And what that's going to do is increase costs artificially, for the one thing. But aside from that, it requires a lot of government intervention to support that transition And you're already having these monetary issues on the side, plus external spending pressures related to defense now with Russia and the need to protect that, the need to protect consumers and in general. The question remains to be seen whether or not Europe can monetarily support this sort of decarbonization initiative. And then you're also going to be dealing with contradictions within the ESG mandate, where many of the components that are integral to making green energy technology viable, whether you're talking about the batteries and the lithium or different components, a lot of those things are connected to very nasty labor practices in sub-Saharan Africa. China controls a lot of the minerals that are needed in order to manufacture these technologies. You're looking at child slavery issues in Africa with lithium, for example, et cetera. So you're having countervailing mandates and risks from an ESG standpoint in terms of, if you want to go green, how do you afford it? And then how do you do it in a way that the E doesn't wind up butting up against the S and the G in terms of your risk matrix, right? So from a regulatory standpoint, there's a lot of catch-22s built into this. And if you want to sort of thread the needle with anything related to green energy in Europe, it requires a lot of very careful screening, due diligence, and geopolitical risk intelligence, because all those risks are present and they're not necessarily coherent because they're contradictory.
Let me turn to banking. You mentioned the turmoil in Switzerland. I'm going to call it turmoil. Also, Deutsche Bank. I cannot imagine the German government would allow Deutsche Bank to either fail or be taken over. But the European Central Bank, the Bank of England, the United States Fed all play a role in the global monetary and fiscal policy. Do you see those institutions remaining robust and remaining as part of a sort of a triad of Western countries that have an ongoing dialogue and work to stabilize as much as they can the financial systems?
Yes, as best they can. Whether or not they're able to do so, I think, is up in the air at the moment, partly because of pressures against the dollar elsewhere as a result of Chinese sort of monetary diplomacy, but also from the way that everybody reacted to COVID. They misunderstood the economic problem that COVID created. They stimulated the economy thinking it was a normal downturn, but it wasn't. It was actually a supply crunch. It wasn't a downturn in demand. When everyone stays home as a result of COVID and everything shuts down, that creates a supply crisis, not necessarily a demand crisis. But when you infuse government support to sort of ride out the pandemic, but you're not manufacturing everything or you're not opening businesses around the world, which is what happened, you're going to wind up with very little goods and services and a whole hell of a lot of capital chasing it. And as a result, you're going to wind up with inflation. So they're raising rates to sort of deal with this. And what that's doing is it's making loans unaffordable for a number of sectors now because you can't afford the capital needed to expand your business. And inflation is high. So you're winding up with this sort of Western worldwide stagflation. And whether or not Europe and the US conjointly can get out of that remains to be seen in the near future. From a banking standpoint, it's not good because they have to raise rates to sort of tamp down the inflation, but you may have to flush more capital into the banks and create more inflation to sort of deal with the banking crisis. So you're kind of like putting out a fire with a bottle of vodka at that point.
I can't think of a better way to end this episode, Ian. I hope our listeners will join us for our fifth and final episode where we take a look at Asia Pacific region and China. Ian, I look forward to continuing this conversation.
Thank you.